Good morning, everybody, and thanks very much for joining us on this last session of the Prescient multi-asset webinar for the year. Can you believe it that we're already in the fourth quarter? I mean, our time is flying when you're having fun. I hope that you all will have a prosperous fourth quarter after the bit of a wobbly we had during the third quarter. But as always, we believe that predictability creates peace of mind, and hopefully you'll get that impression through our webinar today. In each of our webinars, we've in the past highlighted our key themes that we see for 2021, and one of those has always been inflation and the impact that will have on interest rate paths going forward, especially in the US. And we decided to change tack a bit on that today. So we're going to spend some time on a bit of analysis on the interest rate cycle and our views around interest rates. And we hope that that would also give you some insight into our thinking and some confidence in the process that's followed behind the scenes in constructing our portfolios. Then we'll recap on our asset allocation views, our drivers of alpha across our multi-asset products. And when I mention multi-asset products, it's really important to understand that our balance fund, our defensive fund, our global balance fund manage on exactly the same process. So if you understand the process for one, you understand the process for all. And there should be no surprises. Just note that during the presentation, we'll be trying something new. We'll be running some polls just to ask you a few questions to get some insights into our attendees. So please bear with us, complete those, and it should provide some interesting insights into some of your views and the ways you manage your clients' relationships. And then, as always, we'll run a Q&A, so the questions will come up, and at the end of the presentation, we can address some of those to our portfolio managers. So on that note, we're joined here by Bastian Teichgreeber, who's our CIO, and Rupert, Hare, who's his 2IC, and they're going to take us through the multi-asset webinar for quarter 3 for 2021. Hope you enjoy and find it insightful. Thank you.
Thanks everyone for joining. So yeah, interesting times the last couple of weeks. As Maya said, we're going to speak a little bit about more detail about interest rates today, mostly about easy financial conditions and what that means for markets, obviously supportive for markets. And we're going to do a deep dive into US inflation because we think that's the biggest risk to our view. But before we go there, let me start by quickly recapping our investment philosophy once again. I'm going to do this in a kind of like speed dating fashion because you've seen this before so often. I don't want to bore you too much, but it is important for us to always kick off with our investment philosophy. So if you think Prescient, we really want you to think systematic investing. And if you think about systematic investing, we really want you to think about Prescient. So that's probably the best summary which I could give in terms of our investment philosophy right in the beginning. But what does it mean for us? So for us, systematic investing is rational, it's rules and evidence-based, and it's data-driven. It's rational, where we look at statistically variable facts in a very sober and objective way. Okay? It's rules and evidence-based because we run our strategies around predefined and tested set of rules which have predictive power and which we have tested through thorough research. Systematic investing is data-driven. So we process more than 100 million data points each and every day. That's a lot. So we say that with pride because we do think that this gives us a little bit of an information advantage against our peers. All of this we do because it leads to unbiased decisions and clear strategies and processes. Clear strategies and processes, what that means is that if we come into the office in the morning, we know already what to do. Unbiased decisions, what that means is, as an example, when COVID-19 hit, we were not fearful. And on the way back on the recovery, we were not greedy. So we have a set rules of a set of investment rules and guidelines which we follow under all market conditions. And as I mentioned earlier, they have been tested and they have predictive power, and we check for that on a daily basis. So we are very calm and we're very unbiased to create this long-term outperformance. And we truly think that this is only doable if you really have a systematic approach, which you can always fall back to. Okay, so we are strong subscribers to long-term asset management. So long-term asset allocation dominates investment themes like market timing and stock selection. So as you know, we are fully active. We are active as any other active manager in every instance, but we don't stock pick. And that's why I actually had to say the first part. Why don't we stock pick? Because there's a lot of evidence that stock picking doesn't work. Okay, as simple as that. So activism just doesn't mean that you have to do the active things that everybody else does. It means you must actually, for us, our interpretation would be you do the things which work and the things which most importantly matter. And that would be long-term asset allocation. So let me show you 2 charts right in the beginning. So you can see on this chart that on the red line, we have all the multi-asset income funds. On the blue line, we have the multi-asset high equity funds. And over the last 5 years, you can see that the income funds have actually beaten the balanced funds by 9%. So that's quite a lot. And that's, for me, the perfect example that asset allocation matters. Because if you would have made a bold asset allocation call, selling out of all your balanced funds, everything into your income, that would have helped and you would have outperformed massively. That is much more important, would have been much more important, by the way, than having a little bit of more or less Naspers, having a little bit of land bank or not land bank, or having avoided Steinhoff. That would have saved you a few basis points, maybe 1% or 2%, but clearly not 9%. The issue is with asset allocation, it works over the long term, and you have to keep the long term in mind. So that brings me basically to this chart. So if I look at this chart and then maybe once again move through time, you can see that if we look not only as far as 7 years back, we chose 7.5 years actually because that's the inception of our balance fund, you can see that over the last 7.5 years, the average multi-asset high equity fund has beaten the average multi-asset income fund by almost 400%. Okay, so it dwarfs your 9% over the last 5 years. So there's 2 messages from this. The first one being you must most definitely focus on the asset allocation. That's the decision making. That's where the decision making matters, and that's where basically the important investment decisions are made. And secondly, you have to look long term. If you get like tied into short term market timing, you could have had an income fund here, you could have a more equity exposure here, but that doesn't really give you an answer over the long term. Long term, you need the right strategic asset allocation. Okay, so the category has worked it out. The issue with our multi-asset high equity category is there's a massive amount of dispersion. So that's what we're showing on this chart. You can see that I could bring up any balanced fund in this category here. These are literally all the 200 names which would be in there. The blue line is our balanced fund. We've done well, but I really want to focus on the dispersion here. So if you look at the very right-hand side of the chart, between the first fund in the category, and I'm not going to disclose who that is, and the last fund in the category, which I'm also not going to disclose, there's a dispersion of more than 100%. Okay, so this is, again, just multi-asset high equity funds, and you get a massive dispersion. So what I'm trying to say is, you might get away with not having the top performer in this category. You might get away with that, but you will not get away with choosing one of the underperformers. So if you are too aggressive, if you are not hedging your bets, but rather basically being very, very brave and picking funds which might be outliers at times, you might end up with some of the funds at the bottoms, and your clients will suffer from that. So what we're trying to achieve is really to be much more consistent. And to achieve that, what we're doing is we're running a process which makes sure that we are always, basically almost always better than average. So that brings me to a quote from Michael Jordan, which I always use. He used to say, all I always wanted in life is not to be average. And we also don't want to be average. So we want to be much better than average. We're quite ambitious over the long term to get it right. But the focus here is long term, and your journey also matters to us. So what we can see on this chart is on the y-axis, the percentile ranking, on the x-axis, basically just the time, and we're looking at 1 year rolling returns. So if you get the highest rolling return in the category, you would be sitting right at the top. If you've got the lowest rolling return in the category, you would be sitting at the bottom. Okay. So I can choose any fund. Now I'm just choosing a random red one here. I can choose anyone. They will all have massive dispersion. So what those guys would normally do is they can, and I'm choosing funds at the top here, which are basically the stronger performers. They would go top to bottom, top to bottom, top to bottom. Okay. So if I take this away now and basically focus on the blue line again, you will see that our line is much more stable. So there's not a lot of funds which never go to the bottom. But never going to the bottom, almost always being better than average, that takes you to the top very quickly. So if we now look at 3 years rolling, you can see that our balance fund moved into the first quartile moves in the first quartile more than 90% of the time. If I would go 4 years, 5 years, and we're going to do this later in the presentation, we will have a 100% hit ratio in the first quarter. Okay, and that's the difference. So we want to be at the top, but we want to get there in a stable way, and we don't want you to experience a massive volatility in your journey with us. And we also want to be acknowledging the dispersion in this category. So how do we get there? And I mean, the best of both worlds is really our philosophy here. We're bringing together the best of both worlds, active and passive. And active and passive, bringing that together for us means not having a lot of some funds in the active space and some funds in the passive space. For us, it also doesn't mean to be somewhere in between active and passive. That's also not where we want to be. Where we want to be is really bring together the best of both worlds. So there's good elements for passives and good elements from active strategies, and we want to combine them. So how does that work in practice? So why do we like passive funds? We like low fees. Our balance fund has 30 basis points fee. We love low transaction costs. So our balance fund has lower transaction costs actually than most of the pure passives, because we save on brokerage within our Prescient group. We save on brokerage because we don't have to pick small caps. We save on STTs or security transfer tax because we don't do physical replication. So our transaction costs are mostly lower than a pure passive. And we've got low tracking error. So you've seen above that other than other pure passives, we get it right in terms of never being lost. So that's what we call tracking error. We don't want to be lost, and we actively manage towards being better than average all the time. But then we are active. So why are we active? Because we think we can do better than a pure passive. So which elements of the actives do we use? Well, all of them, all of the ones which work. We generate within asset class alpha, but here we focus on the fixed income side of things and not so much on stock picking. Why? Not because we can't stock pick, but because there's scientific evidence that stock picking is a particularly tough task and that most guys can't get it right. We have an efficient allocation of capital. So our strategic asset allocation is not set in stone and never changes. That's a problem, because if you have a set in stone strategic asset allocation in a pure passive balance fund, it will not work, because long-term expected returns change as inequality changes, as demographic changes, so structural breaks, etc. So we are adjusting our strategic asset allocation for that. And we are capturing market dislocations. So that's our last point. We are very active in the tactical asset allocation space, because we do think if our models align and hint us towards certain asset classes being cheap or expensive, there's no reason for us to not being active. Okay, so that's basically the summary around our investment philosophy. We want to bring this back into praxis now, and I mean, we spoke a lot about systematic investing and how we look at numbers very detailed. So I want to dive straight into it together with you today. So as a starting point, I want to look at the 5 big themes. 2 of them are grayish because we're not going to focus on these right now, but we've got 5 big themes for 2021. The first one is COVID-19 and the impact thereof. The second one is easy financial conditions, and the third one is reflation, or the great reflation trade and higher inflation prints in the States. So COVID-19 is unfortunately still going to stay with us. So we have to continue to monitor the impact of COVID-19. Are the vaccines really working? Will there be new variants? Will we reach herd immunity? Will there be another outbreak? And then from an economic point of view, do we need more lockdowns? Can we just open the economy entirely if we have, call it herd immunity? Can we reach herd immunity? All of these things we're measuring closely. The first big implication from COVID-19 is easy financial conditions. So we all know, and we almost tired speaking about it, we all know that central banks have flooded the markets with liquidity. We all know that the Fed is running very low interest rates which are most likely not going to go up over the next year or 2. And there's a lot of quantitative easing still happening, not just with the Federal Reserve, but also with the ECB. So as we speak, the Federal Reserve and the ECB combined are buying at a much higher pace. So they're pumping more cash into the system than they've done during any period post-COVID-19, during any period at the peak of the great financial crisis. So that is something which is very supportive of basically all asset classes. And that's what has tilted us towards more risky assets, more equities, which has benefited the fund's performance. But then I also want to focus, and that's why I'm going to drill in a little bit more detailed now on reflation. So that's at the bottom right of our screen here, the big reflation trade. And why am I mentioning that one? Well, the reason why inflation is so important to monitor is because inflation is the #1 key risk for us when it comes to the easy financial conditions. So if there's one risk out there, why financial conditions might be tighter than what the market is pricing for, that would be higher and more sustained inflation in the United States. Okay, so we've seen 3 consecutive inflation prints above 5% in the States now, 5.4, 5.4, and then the recent one at 5.3. So it is something to look at and something to be concerned about. Having said that, our take is that inflation is going to be transitory. We don't see inflation to be here for longer, and we're speaking years inflation. That's very important, very different beast to SA inflation. And because of that, we don't expect the Fed to hike any faster than what the market is currently pricing for. Okay, so let's look into inflation a little bit more in detail. So this is going to a little bit into the nuts and bolts of things, and a little bit into like an nitty-gritty analysis, but it is important for us because we want to get across our thinking here and highlight how our research at Prescient generally is conducted. So if we look at inflation as a starting point, you can see inflation is a volatile number. So it used to be very, very volatile, more volatile back in the days than it's now. So the first thing which I'm going to do is I'm going to cut out the period before Bretton Woods, before we basically got rid of the gold standard, basically the post, the pre-World War II area. So we're taking that away. Okay, so then I'm going to zoom in even further because now you can see 2 big spikes. These were basically the inflation crises of the 80s, which also mostly driven by oil prices, where there was a lot of reaction towards it, and which is something which we don't think is necessarily representative anymore. Paul Volcker got everything under control basically in the period thereafter. So the inflation regime which we are looking at right now is basically this one, where we're basically starting in the early 80s and then looking until today. As you can see, inflation is high, 5.3, the most recent print, but we've been there before. So we had inflation prints at higher levels, 5.6 actually in July 2008. We've got much higher inflation prints, above 6% even in the early 90s. So inflation has been higher. And the one element here has been that inflation has always been strongly mean reverting. Okay, so this strong mean reverting characteristics are just very important when it comes to inflation. So I want to look into this a little bit more detailed by focusing on the monthly CPI basket. So what makes up the CPI basket? And just quickly, 2 observations here. Shelter, which is the red one, is a big portion of the basket, and that has not changed. New and used car sales, which is this yellow area, again is like 7-8% portion, and that has not changed. So if I just look at this chart, you can see that the CPI basket over the last 20-25 years has been very stable. Okay, so that's important because now we can use the past with much more confidence to make inferences for the future. Takes me to this chart. So this basically is showcasing each and every element which is contributing towards inflation over the last 20, 25, 30 years. And you can see the individual prints here are basically now the individual contributors. So if I just highlight shelter, for example, you can see a lot of bars here because shelter always has been a big contributor. That's because it's such a big element of the CPI basket. Then we want to also highlight motor fuel that's driven by the oil price. So you can see it moves up and down extremely strongly. So it basically detracts from inflation or adds to inflation as the oil price goes up or down, plays an important role. I really want to focus on now is new and used motor vehicles. So these yellow bars, you can barely ever see them because they are very, very small in general. Okay, so the only area where we are basically seeing these bars highlighted is at the very right-hand side of the chart. So if I now basically zoom in once again and focus what is making up inflation right now as we speak, you can see that we're seeing this big print of new and used motor vehicles. That's a clear outlier, and we really do not expect this to last. In fact, inflation right now is made up of 3 elements. It's motor fuel, which is driven by the oil price. It's shelter, which is normal, but not higher than normal. And then we've got obviously new and used motor vehicles, which is adding so aggressively to the print. So just one or two last charts on that here. I want to quickly go into the world of machine learning very briefly by basically doing a k-means clustering. So we're basically just checking all of these individual building blocks. How would they have contributed individually to inflation historically? So you get different clusters then. So how does a high inflation trend historically look? Can be made up of something like this, where we have a housing crisis, where shelter is contributing aggressively. We don't have that yet. Another potential cluster is something like this, where we have an oil crisis. It's not something we're having right now. Cluster 3 and cluster 4 are not interesting because those are clusters with low inflation. What we are looking at right now is this yellow contribution of new and used motor vehicles, which is pushing up inflation, which is something which is not sustainable, because for that to be sustainable, you would expect and have to expect core prices to continue to grow at a rate above 50% for the foreseeable future, which is just completely unreasonable. Okay, my last chart on inflation, because I know I don't want to go too much into detail, although I actually would love to. We're once again printing all the contributors to inflation, and then we are comparing them on basically the x-axis in terms of how much they contribute to inflation. So most of the stuff will be centered around the zero line because they're all individually contributing a little bit. But then let's focus on 2 or 3 things. Motor fuel. So again, a very flat distribution because the red dot here moves to the left and to the right with the oil price aggressively. So as the oil price does not continue to double from where it is right now, because it literally has doubled over the last 12 months, that contribution is going to go back right to the zero line, even if the oil price stays at the high level where it is now. Okay. And then we've got shelter, which is not printing at the higher level than usual. And then we've got this outlier here, new and used cars. Those are really contributing 1.5% on year-on-year inflation, and they will definitely clearly have to move back into this distribution, which means that the contribution will be close to zero. In fact, if we go up and look at things like medical care, you actually see observations which are below the long-term average, which will continue to be below the long-term average, given the developments in the States. So we've got all reason to believe that we will see a pullback from global inflation in a quite aggressive way. Okay, so these are basically our themes why we think inflation is going to come back aggressively. We often get challenged on this. Why do we get challenged on this? Because in the headlines, you obviously read more about inflation being higher again and again and again, and it's just a nice story for the media to basically talk about. But we do think inflation is going to go back to normal, not immediately, but our estimate is over the next 6 to 9 months, and then financial conditions are going to remain easy, and that's going to basically help to support basically risky assets across the globe. Just one last view, because we often also want to speak about the global labor market in the States. Labor shortages, and that's another reason why, which is often quoted for inflation to be high. I just want to go into this chart here very quickly, basically printing the prime age labor force participation rate. So what we're measuring here is basically which part of the workforce of the prime age, which is 25 to 55 years old people, which portion of these people are actually at work, and the number is just at roughly 80%. And you can see that at the peaks of a recovery, it would normally sit at levels of roughly 85%. Okay. There's a lot of people not in the labor force right now because they are still getting stimulus checks, and that's creating labor shortages. But these labor shortages are going to go away. The waiter is once again going to be a waiter once there is no stimulus check anymore, and once he has to go back to work for the pay. So this will take away pressures on wages, and we are pretty sure that all of this will basically alleviate the inflationary pressures, and with that we will have easy financial conditions which are going to stick around with us for longer. So that's basically one of our themes, a little bit of research, but it's important for us to get that message across. Everything is obviously here assessed purely systematically, and yeah, that's why we actually wanted to show it how we do these things. I'm going to hand over to Rupert now for a while to speak about basically our asset class views, and also like drill into some of them. So basically bringing the theory even closer to praxis.
Thanks, Bastian. So as a reminder, within our balanced funds, as Mayor mentioned, balanced defensive, and global balanced. We follow exactly the same process, and that is guided by this general TAA view across global asset classes. So we start with our base foundation of our strategic long-term asset allocation, and then away from that, we take small tilts in order to capture what we see as alpha opportunities. So just to go through our views, and as a reminder, this is a distillation of all of these 100 million data points distilled into a very simplistic viewpoint, which we look at every day, and we tilt our portfolios accordingly. To go through our views, starting on the top with equities, we remain bullish on South African equities in particular. That's primarily a case of value, and I'll show you a bit more detail of that in a slide or two's time. And then continuing with South African asset classes, nominal bonds, a very strong overweight, countered by underweights in European and to an extent US bonds. And then going down, continuing in South Africa, inflation linkers, again, very strong overweight. We see that as a very attractive asset class. And then major asset pairings versus the dollar, in general, the theme being bearish dollar, bullish on other major currency pairings versus the dollar. So in particular, the rand has been an overweight for us for quite some time. So I'll show you exactly why that is the case as well. So taking you into South African equities, we use a combination of what we think are the 4 pillars that drive performance within markets. So those being valuations, economics, financial conditions, and sentiment. Overall, we're seeing a positive case for 3 out of 4 of those variables. Financial conditions, very stimulative. We know that across asset classes, Bastian has mentioned, there are easy financial conditions which have led to rallies within risk asset classes around the world for the past year and a half. But then at the same time, within South Africa in particular, there's a very strong case for valuations within the equity market. So what that looks like, if you look into what these components are built out of, in valuations, we've got price to earnings, price to book, price to sales, relative earnings yield, and 3 out of 4 of those are showing a positive case for valuations. Financial conditions, as said, there's a very strong positive case there, very supportive monetary policy, credit spreads extremely low, funding pressure is very supportive, and cross-currency basis, again, a very, very low spread there. So just to drill into what it looks like, in particular in the valuations perspective for South Africa, and this is a very different case to offshore. So in the valuations case for South African equities, we're seeing a positive value case. And to look into in detail one of these indicators. So if you look at the price to earnings ratio, you can see how strong this recovery has been with the release of positive earnings from South African companies. In particular, there was strong positive releases from resource companies. And what that's showing at the moment is that you've got a price to earnings ratio significantly below the long-term median, implying that, at least by this measure, South African equities are cheap. If you look at that on a relative basis versus the MSCI World, again, this is the relative earnings yield, so the inverse in this case of the price to earnings ratio. If it's high, it's good. We've seen this massive spike in South African equities versus global equities, primarily as a result of positive results coming out in South Africa and muted to negative results coming out offshore. That on the back of also strong rallies in offshore prices, and then largely flat South African equity markets. So the value case definitely exists for South African equities, and that takes us back to this overall table as one of the building blocks, where we've got a positive value case supported by a strong economic environment, which is conducive to growth, financial conditions, which are extremely supportive, and at the moment, a neutral sentiment case. So that's South African equities. I'll take you into something which is also quite close to home, this being the dollar-rand exchange rate. Similar case here, where we've got a very strong case for valuations, supportive financial conditions, economics are positive towards a growth picture in South Africa, and then a neutral sentiment view in South Africa. In particular, if you look at the valuations perspective, the real interest rate differential is at near all-time highs, and that means that it's extremely attractive for offshore investors to buy the rand, earn the carry trade, and as a result, to strengthen the rand. So looking at that in a bit more detail, if we go to the valuations tab, Again, this is a case for offshore investors primarily. So here you're looking at a strong carry trade opportunity. If you look at, first of all, the real effective exchange rate, that has been low being good for quite some time. But what is interesting for us is this real interest rate differential, which is since the 1960s currently at all-time highs. So simplistically put, you borrow dollars, invest into rands, and then at the end of the day convert back to dollars, and the premium in real terms that you're getting is actually close on 10% here. So very attractive for an offshore investor to buy into the South African bond market in particular, and for us that means a strong case for investing into the rand and supporting it in the long run. Bastian also just mentioned the US labor market being quite supportive, so let's go into that. That indicator, that being a very strong indicator for the rand, in combination with Prescient economic indicator, industrial metals, which is also supportive to the rand. So if you look quickly into the US labor market, you can see this extremely aggressive recovery within the US labor market. Unemployment currently sitting below the long-term median, and with new jobs coming online, we expect that to continue further. Very quickly to look into economic activity, the story is quite interesting here, where we had post-COVID, we had strong recoveries in South African economic activity, and that has since cooled off quite a bit, but we're still sitting around the long-term median, implying that economic activity goes ahead at what we see as normal levels for now. So what does that mean for our funds in general? How are they positioned? To look into the balanced fund, that means that the current positioning of the balanced fund versus its long-term strategic asset allocation means that we take a view on South African equities, tilting it from 40% to 45%, that funded by a small underweight in nominal bonds, and for the most part, except for the rand, where we have a small amount of hedging in place, that means that we're sitting at our long-term strategic asset allocation, and just having a tilt on within South African equities. So with that, I'm going to hand back to Bastian just to bring it all together.
Thanks, Rupert. I'm going to zoom out a little bit, out of the practice, a little bit back into the theory again. So we spoke about a few things today, in all briefness, obviously. And I want to bring it back to one slide, which we call beating our peers, a very bold statement. But I want to basically recap the 4 reasons why we think we are ahead of our peers and why we think we are going to continue to be ahead of our peers. So the first part is just to recap again, and we didn't speak about this today simply because we've done it in the past. And yeah, there's always a shortage of time in these webinars. But we have to have a strategic asset allocation which is active and dynamic. So you can see this pie chart looks slightly different to what Rupert has presented on, because he obviously included the TAA tilts when it comes to a current positioning. But this is really our starting point, and that starting point has changed. So when we presented to you a year ago, we wouldn't have this 5% bucket in SA high yield corporates. We wouldn't have this 5% bucket in SA infrastructure investments. Why? These are interesting themes which are coming up and which we play, and we want to play them strategically and not just on a tactical basis. We're getting access to more and more asset classes. There are changes. I mentioned it in the introduction already. Post-COVID, we have more inequality than before. Nothing to do with COVID, but we continue to experience demographic changes. There's challenges to long-term economic growth. There's changes to sector exposures when it comes to equity indices, but we're going to be more tech-based and we're going to be less resource-oriented. So all of these things have massive implications. There's a higher demand for a risk premium for emerging market bonds now, with the story evolving around China. So all of these things matter, and they are not necessarily TAA themes or TAA trades. Some of them are structural. Example, China, we think that investors over the long term will require a higher risk premium for emerging market bonds, and with that also on SA government bonds. So that feeds into our strategic asset allocation. We re-optimize it, but again, it has to change, it has to be adaptable, and it has to be smart. tactical asset allocation tilt. So this is basically just recapping what Rupert presented on. So we have views on asset classes, and we have quite a lot of strong views right now. Strong overweight on SA equities, strong overweight on European equities, strong overweight. This is just the equities subset, but strong overweight on the Rand, on SA bonds, strong underweight on DM bonds. Those views we would obviously play, and we would express our views here in a very cautious and predefined risk-controlled manner, which guarantees that we are not detracting too much from our strategic starting point, which I mentioned under 1. And point 3, I'm not going to speak about this too much in detail right now, but we are also active within the asset class. So we don't stock big, but we generate a lot of fixed income alpha. And that's what we are known for, and that's where we are good, despite our ability to then obviously port this on top of our equity building block. So a little bit theoretical, but let me get away from this one. But it is an important element of our return profile. And with that, basically, we are able to continue to generate equity alpha within the fixed income space. So we have a positive contribution on our equity building block. So we're not just giving you index like a pure passive. We have a positive contribution there every year since 8 years now. So that's quite promising. And last but not least, if you don't believe in any of the statements made, we think you should still invest with us, because one important theme is obviously low fees. So what we're showing on this chart is, and we've shown this chart before, is the TIC of the industry on the x-axis and the 5-year annualized return of the fund on the y-axis. And you obviously want to sit at the top left. You want to have low fees and you want to have a higher return. And interestingly, there is a positive relationship between low fees and return. So just saying it, a passive approach is not a bad approach. It's actually a good approach. It gives you higher returns than an active approach. But where you actually really want to sit, and this is exactly where we are sitting, is not just on that line as a pure passive, but above that line. So sitting at the top left here is exactly where you want to be. You can see that there's not a lot of guys further to the left of us. And if so, they would mostly have obviously mostly poorer returns. Okay, so returns is a good catchword. I just want to drill into the fund performance quickly to recap right in the end. But 4 good concepts, 4 reasons for us to beat our peers. Switch off the benchmark quickly. So has it worked? And obviously the answer is yes, otherwise we wouldn't be showing you the charts. I'm joking. But we have actually beaten our peers if we ignore the 1 month period over every measurement period on this scale: 3 months, 6 months, 1 year, 3 year, 5 years, 7 years, and since inception. Every measurement period we've beaten the peer average, and that's what we obviously quite proud of. But it's not about just beating the peer average. Our approach is not designed to move us to being a #1 fund over like a short-term period. Our fund is designed to be better than average over a short-term period and then move to the top through time. And that's again speaking to the consistency story, which I spoke about already in the beginning. So let's focus on 1 year returns again. So we are in the 2nd quartile, which is exactly where we want to be. Throughout 2021, we've been moving between the 1st, 2nd, and short periods, 3rd quartile, but mostly in the 2nd and 1st quartile, which is exactly what we want to try to achieve over the first short term. If I now go down a little bit further, and you've seen this chart and in the intro already, focusing once again on rolling returns. Again, you can see that for most of these years, we've been sitting in 1st and 2nd quartile, as we do right now. Again, which is what we want to achieve, not because we just want to be better than average, but we want to go through the top in a very pleasant and not in a very volatile way. So I'm going to speak about long-term numbers just now. But before we get there, just one last take on consistency, where I want to show another chart is basically this one, where we are just showing the percentage number of observations of individual funds being in the 1st and 2nd quartile. So again, I could use any fund in that category. I'm not going to show individual names because obviously we're not supposed to do that. But within that category, you can see there's just 4 or 5 guys ahead of us. So I checked who those guys are. So who's more consistent in the 1st quartile than 1st or 2nd quartile over 1 year period? Those guys are actually not. So all of these funds are running a much shorter track record, so it's easier to have 100 or 90% hit ratio. All of these funds, by the way, are much smaller in size, and all of these funds are also running much higher fees. So kind of we're not really worried about that we're going to catch them as time passes. But let me now zoom out again and show what that means for longer term periods. I want to go into the 5-year number again. So 5-year number, again, we go to the top very quickly then if we are consistently better than average over a 2-year period or 1-year period. And then you can see this chart where we're basically showing that, yeah, over a 1-year period, we ease comfortably in the first quartile, actually comfortably in the first decile. And we mostly, this is basically mostly the area where we are and where we move around, because again, we have created a process which is giving us just so much consistency to be better than average. And then it just does not take too long to basically go right to the top. Just one last chart on that in terms of ranking performance. I would like to show this one as well. So what we're showing here in dark blue is the percentage number of observations where we've been in first quartile, then in red, the percentage number of observations in the second quartile, third quartile in yellow, and fourth quartile in green. And then on the x-axis, you see different measurement periods, 3 months, 6 months, 1 year, 3 year, 5 years. Okay, so if I start with the fourth quartile, we're barely ever there, but you can see there are some observations over 3 months. Okay, over 3 months, we happen to be last quartile. It can occur, but you can see it's less than 10% of the time. 6 months, it's almost not happening. So last quartile, that's less than 3% of the time. And then 1 year, 3 year, 5 years, no last quartile observations. Third quartile, that can happen. So 3 months, it's roughly 20% of the time that we are only in third quartile. 6 months, it drops to just below 20%. 1 year, it's below 10% of all observations where we're in the third quartile. Okay, second quartile, 2 or 3 years, 1 or 2 years, so 6 months, 1 year, a lot of observations in the second quartile. That's exactly where we want to be over this measurement period. In 3 years, 5 years, you don't get these observations anymore because that's where we already first quartile. Okay, so 3 months, 6 months, you can see first quartile roughly 40% of the time, and then 1 year, 40% of the time, first quartile. But then if you do that with that amount of consistency, 3 years, 97% of the time in the first quartile, and then 5 years, 5 years or longer, obviously, 100% in the first quartile. So that's exactly what we're going to achieve. You need this picture to basically prove that you're getting your performance not just through 1 or 2 or 3 or 5 right calls, not through like a very strong 1 year or 2 year period, but through a lot of baby steps, which basically take you to the top in a very measured and I think in a very humble way. Okay, just one last chart, which I want to talk to you because I really want to avoid us being thrown into the bucket with other passives. We are not passive. I mean, we gave you a lot of views, a lot of reasons, a lot of tilts, and a lot of conviction here, I hope, why we are better than a pure passive. So what we want to do on this chart is we're basically comparing ourselves, and once again, want to look at rolling returns. So we took the top 5 funds in the category, all of them obviously very active. We took the top 5 funds in the category by assets under management. So you know pretty well who those guys are. Probably you hold quite a few of them. And then we measured performance of an equally weighted blend of these top 5 guys against our balanced fund. And when you look at 3 years rolling, there's not even a touch point here. So what that means is there's not a single period, not after a crash, not after recovery, not during a bull market, not during a bear market, where there's a 3-year period where they would have catched us. Okay? It simply has not happened. And I'm highlighting this because often a lot of the active managers would often make the statement that the passive managers are not so great because in a crisis they are better in risk management, or the passive guys would claim that they are better able to capture a bull market because in a bull market the active guys are too conservative. That's irrelevant, to be honest. So our solution is giving you the best of both worlds. We are outperforming in the bull market, we are outperforming in the bear market because we're combining these attractive elements of active and passive in one solution. And yeah, I mean, this basically ends our presentation. Obviously, we're happy to take questions as they arrive. We're 45 minutes in, which is exactly where we want to be. So even our presentations are on the point when it comes to systematically allocating time. So thanks from our side for listening to us. I hope you have enjoyed the experience. And yeah, if there are any questions, please let us know at this point.
Thanks, Bastian and Rupert, for sharing those views with us. to me personally, is always very reassuring to kind of be able to distinguish between facts and story. And we've seen now with your view on inflation and the drivers of inflation in the US, which is a key part of our return expectations going forward, of that rational analysis of that. So I thought before we get to the questions, I'll maybe just share the result of our poll, because it's always interesting to know who we're talking with and who's listening to us. So there's overwhelming evidence that most of you believe that green giraffes sit on chairs in the summer. No, sorry, I think that's the wrong poll. I've got the other poll here. So very encouraging to realize that our audience, more than 50% claim to do their own fund selection. So we normally talk a lot to discretionary fund manager clients, and very encouraging to see this. But more encouraging so is to get the view that 61% believe that investment process is the most important kind of point, most important point to select a fund, and 31% thinks it's performance. Now, we do believe that our systematic evidence-based process is the key differentiator for Prescient in our market, and that is what will carry our success in the years to come. And obviously, that if that is implemented successfully, it manifests in performance. And we also believe that that is clear from what we spoke about. Then also interesting is that there's quite a strong correlation or broad representation of kind of mean reversion of using specialist and generous building blocks in constructing portfolios and using a combo of active and passive. Just the point I want to make there is normally, passive inclusion in a portfolio is primarily for lowering fees, and you'll understand why that is there, but also for allocation to asset classes where the belief is that alpha opportunities are the greatest. Now, contrary to that fact is that what we've seen in the SA market especially, but globally as well, is that the allocation is normally to passive mandates in the equity space, and yet the greatest area where one can add active alpha is in the interest-bearing space, and that's precisely what we do on our equity propositions, is where we generate the alpha in the interest-bearing space. It's one of our key skill sets, and we port that onto equity indices where there's poor evidence of active management adding alpha. So it's just one of these other alpha drivers across our process that makes sense to us, and hopefully will in future deliver prosperous returns for our clients. Okay, sorry about that. If we get to Q&A, just 3 questions for Bastian and Rupert. They all seem to be around the economics. The first one is, what motor vehicles are you talking about when you're talking about the motor vehicle second-hand motor vehicle inflation? Is it electric or petrol?
So that's a good question. I believe it's a mixture of both. And I would think that it's a growing share of electric vehicles. I would hope, at least. But in the United States, I think they don't differentiate between the two.
Yeah, and also the cars are both used and new cars and used cars, and it doesn't really make a difference because it's basically, they're obviously highly correlated. So what we're seeing is obviously a lot of supply shortages, which we are pretty sure are going to go away, and if obviously cars are scarce, then the prices of both used and new cars go up. And maybe just to add a comment there, I mean, if you're following the news in the UK, obviously there's a lot of fuel shortages now. So again, a lot of fear that that there's an issue around the supply of fuel, and that will push up oil prices and inflation. That's not the case. So there's enough fuel in the UK. It's like just no truck drivers basically moving the fuel around. So one has to really drill deeper whether these things are inflationary or not. And we think right now the majority of the inflation drivers are transitory, and that's why our view is aligned with the Fed there.
Yeah, thanks. I mean, I can't believe that the second-hand electric market can be well developed yet. And obviously, as electric vehicles are becoming more popular, you wouldn't expect high inflation on second and petrol vehicles, kind of supporting your point. When you talk about, I think it was about bonds and views on global bonds, when you talk about European Union, I assume that excludes the UK, is that right?
That is right. We have a separate view on the UK. but it's the same. The investment view is the same, driven by similar factors. So there's no demand for haven assets, which means there's no demand for safe haven bonds like UK, US, or European government bonds. And then, so that's from a sentiment point of view. From an economic point of view, we don't foresee the economic cycle to roll over. So the recovery is still on good and sound footing. So there's no need for haven assets, again, also from an economic point of view. And last but not least, we always must talk valuations as well. And obviously, I mean, inflation, we think, again, it's going to come down. But as we talk inflation in the States at 5%, US government bond giving you 2%, 1.5%, 2%. In the UK, it's actually less. It's around 1%. So that's not a great investment with like a currently real return of -4%. So yes, it's separate. But whether we look at UK, US, or European bonds, there are nuances and differences which we track, but we wouldn't be bullish on either of them.
Okay, cool. And then the last one is just a general question on our economy and how do we expect it to pick up with our bad employment numbers?
Yeah, that's a good question. Obviously, not everything looks rosy in SA when it comes to the local economy, but I just also want to highlight that our economic view is linked to the South African equity market. Our South African equity market is heavily driven by offshore factors. Okay? Just an example, we still have a lot of resource companies which are massively benefiting for the global pickup in demand for resources and the pickup in resource prices. The SA unemployment is a particularly tough one to discuss. I think a lot of the unemployment here is to lack of skills. A lot of the unemployment is due to lack of education. A lot of the unemployment, unfortunately, is structural and not driven by the current economic cycle. And unfortunately, because it means we will have to live with these high unemployment numbers for longer. But it is an economy with a very high natural rate of unemployment, which means I wouldn't take an unemployment rate of at the level where it is right now to basically address the economic cycle or the economic challenges we face. Is it a challenge more from a socioeconomic point of view? And it's a problem which we massively have to address also from an inequality point of view, but that's a whole new discussion. We are really just assessing the impact on equities or bonds and that situation from an investment point of view here.
Okay, yeah, I suppose when we look at employment, we need to have a proper grasp of the level of informal employment, which I suppose also drives a big part of our economy. And that's his last question on, you mentioned the the resource companies, the impact that has on our growth and on the equity market, and I suppose on the currency views as well. I mean, do you have any concerns around the happenings in China now with what seems to be authoritarian clampdown on tech companies, power shortages, now the debt crisis and Evergrande and all that? I mean, what can potentially derail this resource story? Is there something there?
Yeah, most definitely. So I think the research story is not going to be derailed by the clampdown on Chinese tech companies. So, I mean, the resource prices are more driven by the whole global economy and also by sectors within China, which where there's no clampdown, and maybe even sectors which the Chinese government might like over the long term. So I wouldn't really draw inferences from the clampdown on tech companies onto the recovery of resource prices. So there I would really not see too strong a link. Having said that, obviously the situation in China is heavily concerning. We are monitoring it very closely. We are concerned, obviously, also in SA with our large exposures to Tencent through Naspers. So these things are definitely very, very concerning, but I wouldn't necessarily link it to the resource cycle, to be perfectly honest.
Okay, great. Thanks for that, Bastian. And maybe just share with us quickly how your Mandarin classes are progressing, kind of seeing that you're following China so closely.
Luckily, with Liang being part of Prescient, we can skip the Mandarin classes for now.
Okay, great. Well, thanks, guys. And thanks to everybody listening to our last webinar on multi-asset for the year. As I said at the beginning, we wish you all a prosperous fourth quarter and happy many returns. Goodbye.
Thanks for the time.
Thank you.